Stock market crash update for you guys. The S&P 500 had another horrific week. If you remember last week, it was down 5.8%. This week, it was down another 4.7%. That means over 10% in the last 2 weeks of trading. But the NASDAQ was also down 4.6%, and the Russell 2000, which was the strongest of the indices last week, was the weakest this one, down 6.5%. There's a lot of technical damage on the charts. There's a lot of carnage. The FOMC statement came out this past week. Jerome Powell raised rates 0.75%. And that sent stocks spiraling lower. That continued into Thursday and into Friday. Now we are at a place that probably most people did not expect us to be at the beginning of the week, and that's at the June lows. In fact, the Dow Jones Industrial Average, which I really don't care too much about because it's price weighted instead of market cap weighted, it actually broke the June lows. So that was a significant development there. And so with the S&P 500 and with the NASDAQ 100, they are both primed to take out the June lows. And this week might be it. But there is a critical factor that's going to be tested this week, a critical moving average that will be tested to where if it holds, we're looking at a short-term bounce. And we're looking at a bounce that could be somewhat significant. Maybe not as much as what we saw off of the June lows, but it could still be significant and tradable. But if it doesn't hold, it'll define whether or not this year's pullback is going to be similar along the lines of what we saw in 2011, 2015, 2018, and again in 2020, or is this a much bigger correction and long lasting like what we saw in 2008 and 2000 when the dot-com bubble blew up? And before we get into all that, make sure that you like and subscribe to this channel, guys. I'm doing videos every week and there's some really great content here, and you can click the join button down below and get a ton more videos every week specifically for members only. So click the join button down below if you are interested in that. Now, coming into the week, I had 4 bearish positions, all inverse ETFs, 2 of which were leveraged ETFs in the form of SDS and QID. My 1-to-1 inverse ETFs were SH and PSQ, with SH being for the S&P 500 and PSQ being for the inverse of the NASDAQ 100. So I came in heavily short, and then throughout the week, I was taking profits. Now, SDS and PSQ, I've almost held for a solid month, and I finally booked the gains in those this past week. And then the other 2 positions in QID and SH, I've got them down to a quarter position. So I've cut my exposure significantly going into next week because I do think that there is a strong potential for a double bottom bounce on the charts. And as a result, I don't want to overexpose my profits that I've made over the past couple of weeks to a significant bounce that almost renders it meaningless. So as a result, I've taken those profits and now I'm waiting for that bounce to unfold. But I still have a little bit of exposure left in the portfolio so that if the market does have that capitulation to the downside, if we break the June lows, I still have a little bit in play. But enough about what I have to say. Let's go ahead and look at the charts here. So S&P 500, this is going to be our first look at what we've got in stake following the carnage from the past few weeks. This is the double bottom that I'm watching really closely here. Here you have a double bottom. Most people are going to expect for some kind of a market bounce simply because we didn't break those lows that were established off of the June 16th lows. If we would have broken those, I think you would have seen a huge rush of stop losses being taken out. However, that didn't happen. And so there's going to be a lot of talk going into next week about whether we are finally going to get a double bottom. Some people will try to say that the bottom is in and that we're going to be surging back up to all-time highs at some point. That's really premature, and you would have to see a lot change in the market, and we don't have the Fed on our side. The FOMC statement said as much. They're going after the housing market. They're trying to bring a correction in housing. They're trying to raise the rates as much as they can. They're trying to bring down inflation. So it's really premature for us to think that the worst is behind us. But there can be some bounces within the sell-off that you can capitalize. However, if this is going to be a dead cat bounce, what I want to really do is be very light and be very aggressive with the profit taking. I don't want to be holding stocks for long-term to the long side. I'm not trying to build a long-term portfolio at this point. But you do have some gaps, like right here, the one that was formed yesterday, and then you have another one that was formed back on September 13th that has yet to be filled. I think this may be an overly aggressive profit target for a bounce. However, the one from Friday, that could easily get filled. Another thing that you want to be mindful of is the potential for a gap down going into the new week to where they try to flush out all the stop losses. You get like this near-term capitulation moment where all the sell orders are flushed out in the early going, and then we see a significant rally into the close. That's a very strong possibility that we see such a thing. But if we don't, be nimble, be ready. Like I said, I've cut down my short exposure because I'm trying to position myself for a bounce in this market, and if we get that, I would like to capitalize on it, but I'm not going to go full tilt. I'm not going to go 100% long. I may get 1 to 3 positions that I play to the long side and try to ride those higher. But when you scroll out some and look at the bigger picture, we are still in a situation here where we're putting in lower lows and lower highs. We've got lower lows going all the way down here. Even though price is slightly above the June lows right now, we didn't actually touch it to the penny, and it's not necessary for it to do that in order for it to be a double bottom. Now, if we do break those lows, I would say look at the weekly chart for a little bit more guidance as to what we can expect. I talked about this last week. We've had significant bounces off of this 200-week moving average. That means you have about 4 years worth of price action in every one of these price plots. And so far, when you go back, you can see where we have held over the years. And now we are very, very close to testing it. But even more so is on the Qs. Guys, on the Qs, this is defined whether or not we are in a major recession or not. For instance, the sell-off in 2020, we went right down to this 200-week moving average and we bounced. Again, in 2018, we got pretty close to it, but no cigar. But we did get close enough to it to render a bounce that was very substantial, but we did not break it. Again, in 2015, we got right down to this price point and we bounced. So you can see the times that we have not broken it has led to some significant short-term bounces that have resumed the bull trend. However, the ones that have not held it were some of the most epic recessions and corrections in market history. Look no further than 2008. We broke it and we had substantial downside thereafter. And it took a great long time to be able to recover that 200-week moving average. You take a look at 2000. We broke it again. And it took us over 3 years to recover this moving average. So there's some significance behind this 200-week moving average that we got to pay close attention to in the days and weeks ahead. So right now, where are we at? We are sitting right on it. We tested it and we bounced off of it. That's big, but we've got to hold it into next week if there's going to be an opportunity to play it to the long side. Now, ultimately, what do I think is going to happen? I don't think this thing holds. I really don't think it holds in the long term. I think there's a good chance that we see it hold next week and we get that bounce, but ultimately, I think we're going to sell off. Now, how did we do back in the day when we actually did break it? Did we break it right away or did we actually get a little bit of a bounce initially? Well, look at this one from 2008 here. You're going to see we did bounce off of it for a couple of weeks, and then eventually we broke hard and fast. Well, in 2000, we actually did get a bounce off of it, and we had about a 2-week rally that ensued. So there is some history that even if it does ultimately break this 200-week moving average, it usually tests it first and then sees a significant bounce. So I am looking for that bounce going into next week. It's not guaranteed, but it's definitely something that I want to pay close attention to. Now, there's no doubt that we're oversold in the short term. You look at the daily charts of the Qs, yes, we got the head and shoulders pattern. We got it to confirm to the downside, but now we're starting to see stochastics readings of 4.44. Now, stochastics readings can stay oversold for a very long time, but then you look at something like T2108 that I have been talking about for a long time. That's the percentage of stocks that are trading above their 40-day moving average. We're at 12.15. We actually got into single digits for like a brief moment at the open on Friday, and then we started to rally off of that low reading on the indicator. So it's now sitting at 12.15. The one thing that we haven't been able to do so far in this 2022 correction is to actually close below the 10% mark and into single digits. That has yet to happen, and that doesn't usually happen until you start to see some major capitulation start to form. But nonetheless, it's a very oversold reading that could lead to a short-term bounce, much like the bounce that we saw off of the June lows, the one that we saw in May, and again, the one that we saw in February here. And then you have the VIX reading that I want to highlight. So over the course of, I want to say, the past 2 years, this goes back to September of 2020, this has been a significant resistance level where a lot of your price reversals have taken place at. It's around the 33 to 34 area. Now, where did we get to on Friday? Not quite to 33, 34. We actually got into the 32s for a brief period of time, but we did not hold it for very long. So this is a weekly chart. Close enough to where you want to say, all right, maybe we start to show some caution. That's one of the reasons why I was taking profits aggressively on Friday, to make sure that I wasn't exposing too much of my capital to a major market bounce. And even if it's a dead cat bounce, I really don't want to have to hold a hefty amount of positions through a very strong short covering or short squeeze. So we're right there at this resistance level, not quite at it, but pretty close enough to where I'm not going to risk it over the weekend. I went ahead and booked most of my gains. They were great. 27% in SDS. There was another 17% in QID. It was really good stuff. But this is that level that I'm looking for. Now, ultimately, when this market does eventually bottom, I'm expecting there to be some major capitulation and for us to get way above that 32 on the VIX. But right now, we're too oversold to really make a strong push above it. Doesn't mean that it can't happen, but a lot of times as traders, we're looking at the probabilities, the odds of some certain event happening. And when you're getting this oversold and when you're holding the previous lows and not actually breaking them, it does set up for an upside bounce. And that's what I want to be prepped for. And if it doesn't happen, I still, like I said earlier in this video, I have a couple of positions, very small positions left to where I can still profit off of it. But if I do get caught in the bounce, I'm not going to be overexposed to the short side, and it's something that I can tolerate and get out with relative ease. And if we get that bounce, I want to make sure that I'm in a position to be able to capitalize on that bounce and to be able to add some long positions. So remember, this week ahead is a very critical week. We've got the opportunity to see whether or not this 200-week moving average holds. I think there's a good chance for that bounce off of that 200-week moving average, though I think it's going to be a temporary bounce. And then I think eventually we're going to break that 200-week moving average to the downside, distinguishing it from what we saw in 2020, 2018, 2015, and 2011, and aligning itself more with the major sell-offs of 2008 and 2000. But what we can do as traders is not to get married to any one direction, not to get married to our stocks, not to get married to our positions, but to manage the risk, to be risk managers. I say it on almost every video, if not every video. We've got to do it. It's so incredibly important. It's what's made the difference for me this year, and it's made the difference for so many traders that either follow me or are part of the trading block or part of this channel, is that they are managing the risk and they're not letting their losing trades define them. They're being defined by their winning trades. And the only way to do that is to manage the losing trades very well. So if you enjoyed this video, make sure to like, subscribe. Tell me down in the comments below, do you think we're going to get that bounce next week? Do you think we're going to finally see the bulls take some action to the upside that we haven't seen since the June bottom lows were established? Let me know. Thank you guys, and God bless.